So, first things first, do banks fail? Absolutely. I remember back in 2005 hearing that the mortgage market, the default rates were on the rise, increasing month over month. Well, today is a little bit different. There's not a whole lot of defaults going on, but the banks are failing. I just read today, First Republic Bank assets were seized and transferred over to Chase Bank. So what does that mean to you as a home buyer out there shopping for a house? Well, it could mean a lot of different things. Like, if a bank fails while you're in the process of buying a house, that could ultimately mean like your process stops. Maybe they can't do the funding. They can't provide the financing for your loan because it literally can stop or slow down dramatically. And the worst thing about it is if you're in a 30-day escrow, it can literally delay the escrow, worse, cancel the escrow, and now your deposit's at risk. You see, not all loan officers are the same. A loan officer at First Republic Bank had maybe no idea about the financial stability of the bank, and they're there doing their job day in, day out, and now they just get a notice that, hey, don't come to work together today. So just imagine that. Like, that's what really happens in this type of industry. Not just to say when banks fail, but also the loan officer can fail at the performance, right? At the performance level, meaning they issue a loan approval and they fail to close on time, and now your deposit's at risk. So just imagine you go under contract, you're a home buyer, you're all excited, you're like, yes, they accepted my offer. And now the loan officer has failed to actually close the loan. And man, at that point, your deposit's at risk, or you put a deposit in escrow, and now, that's at risk. Closing that and purchasing that house is at risk. Everything becomes riskier as a result of that. You see, I have over a 200-point checklist that before we issue a loan approval, we actually have our underwriters review the file, making sure everything's I's dotted, our T's are crossed, everything's been reviewed, so that way when you're going under contract, we're basically have a very smoother process with the home buyers out there. And our clients love the process. So yes, it's more work at the very beginning. So a lot of feedback I get a lot of times like, Dave, you require so much more paperwork. And it's true, because we don't take it lightly before we hand off that loan approval. We take our job very seriously, that when we hand off that loan approval, it's essentially good as cash. Like, you're going to get the offer accepted because we've done our due diligence. And the home sellers like working with our offers even that much more because they know there's just less surprises. So, going under contract is could be very risky for home buyers if the loan officer hasn't done all their due diligence. And it doesn't really matter by credit scores either. Credit scores is just one factor, but there's more things that they have to look at. I had a client that had over 700 FICO scores, but there was something in the bank statements that would have stopped this loan from closing. So we actually had to reach out to their client and let them know this is going to stop the closing. You may, Mr. Realtor, the realtor that was helping them, you may even want to stop showing them property until this thing gets fixed. So there's a lot of variables that are involved with giving out and providing a loan approval. A loan approval to give out, if they don't do the due diligence and they just give you a piece of paper and they just kind of look at their income and evaluate it. And I've been in this business for a long time, and I've actually seen where some unfortunate stuff that loan officers will actually provide an approval when there should have been no approval going out. So you got to make sure that when you get that approval letter is thoroughly reviewed. That loan has been thoroughly reviewed, and a result of that, then you're going to have just a better process. Your offers are going to get accepted much easier with an approval letter that's been reviewed by an underwriter. You think about it. What would you do if you're the seller of the property? You had one offer that, let's say it was, not guaranteed by the underwriter. And then you had another offer that was thoroughly checked out, thoroughly reviewed, guaranteed financing by the underwriter. Which offer would you choose?